Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. The more I say it, the more I like it. I like how it sounds. Today's Tuesday. It's November 14th. It's about 7:51 in the morning. The market's going to gear up to open up in about an hour and 39 minutes, if my math serves me right. It's going to be a big day today, folks. We have the CPI report. Before the market's opening, we haven't hit it. Gotten hit yet. It's coming out in about 39 minutes. By the time you get this video, it should be out. And you can see here, Nasdaq's up just a bit. The Dow's down 6 points. Nobody wants to make real big moves ahead of the CPI. Just to give you an idea of where we stand right now, year to year, we were at 3.7 last time. We're looking at 3.3 consensus, which is good, which means we're making strides in the right direction. On the X food and energy, they're looking at the number to be stuck, which means that food and energy is causing a big issue, as you can see here. But it remains to be unchanged. So 4.1, it'd be really good if it was 4, but 4.1 is baked into the market. So keep an eye on food and energy annual. Don't look at month to month. That's nonsense. But annual. And it'd be great if it was 4.0. or 3.9, and this number would be great if it was just 3.3. But again, the Fed looks at core, and if it moves down to 4, then the Fed can say, well, what we're doing is really working. And if it's 4.1, they're going to say, we told you we need time. We need time. The economy needs time for the things we've been doing, for the increases we've been doing to have an impact on the country. So one way or the other, they'll have an answer for you. But this is a very important number. It's the big report coming out today. It's the biggest report of the week. And then tomorrow we have a 1-2 punch. We have the PPI and we have the retail sales. And depending on today's report, the PPI may be volatile too, but usually they go hand in hand, and most of the volatility gets eaten up by the CPI before the PPI comes out. And also we have retail sales. So today and tomorrow we should have some volatility. And then you have a bunch of Fed speakers. You got retail sales. You got petroleum status report. So it's going to be an interesting week. My suggestion is to keep an eye on the bond market. Because remember, the stock market gets its directional bias, the volatility from bonds. Notice bonds have been very quiet last few days. Well, there hasn't been a lot of volatility in stocks. Today, there's going to be plenty of volatility in bonds, I would assume. I mean, that's usually what happens. Typically, if you look at the last 3 to 6 CPIs, we don't really go very far, but we have a lot of volatility. So we could potentially do that, and that's why I wanted to go into today's session long one stock, high volatile stock, and short 2 low volatile stocks to make up for it. We're talking about the day trading program, just to give you some perspective. I don't want to go all long or all short overnight when we have a CPI report, so it's always good to be hedged. And if you have a very high volatile stock to the long side, you can use 2 or 3 low volatile stocks to the downside, or 1 high volatility stock to the upside, and 1 high volatility stock to the downside, or 2 low volatility, but you get what I'm saying. Keep your eye on the bond market. Now, if the bond market remains below the 50-day moving average, it's going to be bearish for stocks. If we start spiking up here, right here, that's very good for bonds, because higher interest rate means higher bonds means lower interest rates. Lower bonds means higher interest rates. Higher interest rates are bad for the market. All right, as far as earnings, you got Home Depot, you got C Limited. Tomorrow, you've got Cisco, you've got JD, you've got Pan W, you've got Target, you've got TJ Maxx. So we've got a lot of earnings on the way, and markets are still not as stable. They're still waiting for price action. Keep your eye on the bond market. Now let's talk a little bit about the SPY, and then I'll get into all of the nitty-gritty. So you could see here, the SPY is now above the 100-day moving average. The question is, are we gonna plow higher, or are we just gonna sit here and come down? We don't know. We have to wait for the CPI report, but we are above the 200, the 100, and the 50, and the 100-day moving average. So it looks like we can hover around here for a day or two. If you look at the QQQ, you will see that we're really doing great. We're almost at the upper end of this range, and this upper end of the range takes into account this volatility right here, this congestion right here, and it was able to pass it pretty well, almost well. We need to get above this level right here. That's 381.10. If we can get past 381.10, we will go higher, but we first have to get past that level. And we're kind of just sitting right here at the top. The question is, are we going to go lower, break through this, or are we going to go higher? CPI, folks, CPI. And if you look at the Dow Jones, you will see that we are literally right at the 100-day moving average. This has been the weakest out of the three, which implies that blue chip stocks have in fact been weaker than tech stocks. That's been a certainty over the past few months. Now, let's talk a little bit about global economy, and then I'll get into sectors, and then I'll get into some stocks. So we're all keying up for consumer inflation report that provides additional insight into Fed's monetary policy. It's a big, big report, and the Fed pays attention to it. Vice Chair Jefferson said Tuesday that monetary policy might need to adopt more forceful measures than useful to keep inflation expectations anchored, particularly when the duration of high inflation remains uncertain. He couldn't have been more straightforward. They may have to continue raising rates. There's now almost a 25% chance of a 25 basis point rate hike in January, although I'm not really seeing it just yet. But the odds are increasing. I don't think the Fed's going to do anything this year. The odds are only at 14%. But I think January, February, depending on what the market does, depending on what the inflation data does, they may raise. They are in a sit and wait mode right now. You've got Home Depot coming out with earnings today. That's going to be very important. Let me see if it comes out before the open or after the close. Let's take a look here. Not yet. Probably after the close, if I had to guess. But that'll be an interesting one. You got, as I mentioned, consumer inflation on an annual basis. We're looking at 3.3, down from 3.7. On a core basis, we're looking at 4.1 from 4.1. It'd be great if this number was 3.3 and this number was 4.0, which means they can say, hey, what we're doing is working. We don't need to raise rates. Interest rates bond market would probably rally on that, and it would relieve pressure from stocks and would cause stocks to rally pretty well. Europe, futures are up 0.24 this morning as investors digested a slew of important regional economic data. We're getting a little tailwind. Auto and basic material stocks propped the market higher. China closed higher as investors looked ahead to a summit between the leaders of the two world's largest economies. Remember, we have the debt ceiling, I think, this weekend, right, coming up. So don't get too excited about the market. Chinese new loans fell sharply in October from prior month, exceeding analysts' expectations. That's not good. Japan, higher, fueled by anticipation that domestic companies would continue posting strong outlooks, while investors also awaited U.S. data. They're keying off of U.S. Energy stocks are up, financials, consumer cyclicals are up. Japan is doing better. I'm glad to hear that. And again, you've got earnings on Home Depot today. This is a retail week, so we have to keep our eye on the retail. Now, here's where things get interesting. Over the last 6 weeks, tech, semiconductors, utilities. Do you see how mixed up sectors are? Invesco, QQQ Communication Services. So you could see clearly that utilities and tech stocks have been leading. Now, have you ever heard me say that before? Utilities is the most defensive sector. These are the most speculative sectors. Do you see how mixed up this market is? It's insane. It really is insane. Now let's look at it over 3 weeks. Well, we got chip stocks, and then you got home builders and consumer discretionary. Well, at least home builders are a little more speculative than utilities, right? But you could see here that energy's all the way at the bottom. Retail's all the way at the bottom. Now look at this. Communication services is down here below the Russell, and technology's up here, and consumer discretionary. No rhyme or reason. I mean, I have never, ever in my life seen sectors so messed up. Now let's look at it over the last 5 days. Still tech. Now, you got communication, you got QQQ, technology, semiconductors. This is looking good. And consumer discretionary is not that far away. I like industrial stocks. They're pro rally. Home builders are starting to come up with industrial. That's good. But look at retail. This is a week of retail earnings. Look at retail. You see that there's a big problem here. Retails are off. Meanwhile, QQQ's breaking the 100-day moving average. So it's a very tumultuous time in the market. So what do we gather from all this? Well, we can gather that technology has still been, broadly speaking, technology has been leading. Small caps and blue chips have been lagging. That's probably the best we can get from this. If you start going too deep, you're going to get so confused, I don't even know what to tell you. So with that in mind, let's look at some technology growth stocks to the upside and some blue chippy stocks to the downside, okay? So, for example, let's take a look at stocks making swing highs right now. Let's look at highs making 24-week highs. Well, look at Uber. I remember somebody saying positive things about Uber. Uber still looks good. I like Uber. I like Uber. I like Walmart, even though it's not a tech stock. It's bucking the trend completely. I love Walmart. I love CrowdStrike. CrowdStrike. Who made money on CrowdStrike yesterday? So here's what I like. I like Dell. I like CrowdStrike. I like Progressive. And I like Walmart. And I like Uber. And I like Meta too. Those are the stocks that I like. Now, what about my top one? Probably be CrowdStrike or Dell. Probably Dell because I really love how it looks right now on the charts. One of these two. Now let's talk about bearish stocks, right? Let's look at 50-day lows. Oh my. Albemarle, Basic Materials. They've been awful. Crocs, they've been doing bad, and retail has been doing bad. So I just found two, and this one, CHRW Robinson. So if I was to choose from three stocks for the short side, Albemarle, Crocs, and CHRW, those would be the three weakest. I think these stocks will go weaker, and the tech stocks that I just called out will go stronger. Now, before I let you go, folks, occasionally a trading insight comes along that makes you sit up and take notice. This is big. Now, this week, I had the fortune of discovering a pre-market trading strategy. Yes, pre-market trading strategy from a top-tier expert in the pre-market trading field. Now, this strategy orbits a unique candlestick pattern that emerges around 7 a.m. Eastern Time. This isn't just any pattern. It's a precursor to some of the day's most dynamic market moves. Now, I know it might sound a little crazy, but this very pattern played a very crucial role in alerting him to major market upheavals like dot-com bubble and the great financial crisis. The best part? He's agreed to share his insight on how to leverage this 7 a.m. pattern, and I'm going to invite you to join this exclusive club. It doesn't cost a thing. Just hit the link below and secure your spot. Don't miss this chance to elevate your trading. Do it now. Follow the link below. Also, make sure to subscribe to my YouTube channel. If you don't know how to find it, go to YouTube, go to the search bar, go to Roger-Scott. Subscribe to my Telegram channel. If you don't know how to find it, it's below my YouTube videos, or go to rogerscott.com/telegram. That's rogerscott.com/telegram. And if you have any questions, send me an email, roger@rogerscott.com. You guys have a great day, and wear a helmet. We don't know what's going to happen with this report. It can go one way or the other. And I'm not big on predicting what the Fed is going to say. That's a futile exercise. Have a great day, and I'll see you guys in VIP room at noon today, and I hope you're there. Bye.